All right, Jared, thank you so much for joining us. Really, really appreciate you taking the time, sharing your knowledge, your wisdom, experience with us and all of our users. So how's your summer going so far? Are you doing anything fun?
Yeah, having some fun. Trying to work a little. In a online MSF class. That'd be a master's in finance. The introductory class, their first one into the program. So I'm doing that online. So fortunately, I can do that anywhere, just as long as I take my brain with me. So I'm doing my live sessions in Avalon, New Jersey. We have a little house, little shack. It's a beach community for those not familiar. And so I get to go on the beach and do a little fishing. The fishing part is the fun part.
Oh, I always loved fishing on the Jersey Shore. Catch some interesting stuff.
Maybe we'll do that sometime.
Yeah, it sounds great.
Yeah. Well, yeah. So
that's
fun.
Cool. So I know that you've been hard at work producing this curriculum around reading and understanding corporate financial reporting. So can you tell us a little bit about this project and what inspired you to take on the subject?
Sure. We were working. We have a company called eLearn About Videos, and we provide educational videos for undergrad, grad students, and business practitioners. We've done some around using your financial calculator in Excel to solve what we call time value problems. And our next step was to build a curriculum around understanding financial statements. And we're targeting this for people with no business background. So it could be like somebody, a plumber or a carpenter, wants to get excited about this wonderful world of investing, but they don't have the background. Mm-hmm. So we're going to kind of walk the users through just the basic financial statements, and then just kind of build from that. So it could be used as a refresher or just a new one. We start at the level where we assume somebody knows nothing, and then we build from there. So we're going to add a lot of depth as we progress through the project.
Okay, so assuming someone knows nothing, and the subject that we're here to talk about, financial statements, what are they? What broadly speaking, what types of statements are there? What are companies conveying through the use of financial statements?
Okay, publicly traded companies will provide annual reports. And in the annual reports will be some descriptive comments, verbiage from the firm about its recent performance and outlooks for the future. And embedded in the annual report are four financial statements. There is the balance sheet. And the balance sheet looks at, and some people call this a statement of financial position. So it looks at how the firm got what we call assets, the things of value, and that, for future benefit, and then how they were financed. And that'll be the claims, or what we call liabilities, and stockholders' equity. So the balance sheet looks at the assets, the things of value that the firm has, tangible and intangible, and how they were financed. And so this will be at a point in time. So if you look at a balance sheet, they'll say balance sheet, and then as of a certain date, such as maybe August 8th or August 9th for my mom's birthday. So August 9th, 2023 or 2020 X, whatever we're going to be dealing with. Then we have the income statement. And this is going to be looking at the firm's revenues and its expenses, including taxes, got to pay the man. And from that, the earnings that the firm makes over a period of time. There's also the statement of stockholders' equity, and the stockholders would be the owners of the business. And that statement looks at the change in the owner's investment in the firm over a certain period of time. And then finally, being the finance guys, we have this statement of cash flows. Mm-hmm. And this looks at the cash flows from the business, how they issued maybe new securities or paid off debt. And also included in that is the investments. Where did they put those funds that were generated? From those are the four general financial statements. And so we're going to look at each of those. And again, we're going to start low, assuming nothing, and then build from that.
Okay, so what do you think, as our users are trying to understand companies, what they're doing, how they work, are they good investments or bad? They're looking to discuss information about these companies, and one of the things that we've tried to do is give them, the best financial statement data that one can find. But besides being able to just access it, like what do you think is the value of being able to understand financial statements to investors, everyday investors?
Oh, sure. I mean, this is the numbers part. I mean, like when we read the financial statements, of course, they're going to be glowing. Sometimes we'll see like a significant downturn in one quarter, and the firm will kind of dismiss that. Oh, we had a little downturn, but it's all going to be good now. So we got to expect that there's going to be some kind of bias in the narrative of the reports that are issued by firms. But the financial statements, that's what actually happened. So we're going to be using those financial statements to get an idea of the firm's operations. What are they doing? Is the firm doing better or worse? And a thorough understanding of the financial statements is going to be necessary for our valuation. So some people call the analysis of the financial statements a fundamental analysis. Mm-hmm. And from that, what we're looking at here is the operations of the firm, and can we identify firms that are undervalued, and then maybe even firms that are overvalued. Because in the markets, I mean, there's all kinds of opportunities to make investments. It's kind of like the casinos, but a little less from the house side of it. But, the more information we have, the better our decisions. I mean, if we think about all the bad things, all the bad decisions we made in our lives, we can usually go back and say, well, if only I knew this, or if only I knew that. And then I wouldn't have done that, or I should have done that. So understanding the financial statements will be really cool for understanding that, and hopefully reduce our mistakes.
Yeah, I love that perspective. I mean, that's sort of part of our mission statement at Irvin, and part of the purpose behind what we're doing is that informed investors make better decisions. And that's what leads to long-term wealth creation. And so that's what I hear you saying as well.
Yeah. I mean, you can get lucky or unlucky, but doing the analysis and understanding what the firm is doing and trying to do. And then, so we got some directions from different analyses and the firm's websites, et cetera. But really, when we're looking at the financial statements, then we got an idea of what is actually happening. And then we can kind of look at it through time. We can compare it to the performance of other firms overall, and specifically in the same industries. Hey, is this firm doing better than that? How's the industry doing? All part of this analysis.
So what I hear you saying is the companies might say all sorts of things, but numbers don't lie. But sometimes
that's what we're hoping. We're hoping,
right? So I think it's maybe important to take a step back. Financial statements are sort of they're sort of the foundation of our publicly traded regulatory regime. Is that right? So who's in charge of ensuring that companies are both meeting their duties, but what happens if they don't follow the rules? What happens if they misrepresent something in their financial statements?
Well, the different regulators, depending upon the firm, for securities, we have the SEC and other groups. We have those types of organizations. They have oversight. We have for publicly traded companies, we have auditors coming in, outside accountants that will look at the financial statements. And so we can generally assume that the numbers are reliable. But again, I tell my students, approach it with a degree of caution. It's our best thought about how the firm is actually doing. But there have been cases where, people have misled. I mean, a good, strong accountant can mislead the auditors, at least in the short term. Maybe not in the long term. I mean, at some point, there's a settling up. But in the short term, people can get misled. And, that's the role of the the auditors to reduce that. But nevertheless, we assume that they are correct. But we have to make sure that we're understanding that this is an assumption.
That's right. And as shareholders, you do have, there is some level of recourse, right? So if a company does misrepresent something, shareholders often have recourse through class action lawsuits. It's not a great option. It often results in you getting less than, what the damages actually were, but it is something. And that's kind of the fundamental premise of our regulatory regime, right? Is that it's a disclosure-based regime, and the SEC is not there to vet those disclosures for accuracy. They're just there to say, this is the standard of disclosure. This is what you have to adhere to. And, they, of course, enforcement will sometimes find problems, but more often than not, you actually find that it's the market that finds these problems or these misstatements, rather than regulators.
Yeah, I mean, they have more of a financial. The markets are really neat how they work. I mean, it's just really exciting. People have financial incentives to make sure that the information is correct. The regulators, they get paid no matter what, but the people making the investments, they can lose. They can lose their money, and so they're going to have that oversight.
Yeah. And then, there's this whole side of investor activism, right? Which sort of plays into what you're thinking, right? Where maybe a large institutional investor sees something that they don't think is right, and they will either publish that fact or oftentimes come in as an investor and push a company to, if it's not a question of misrepresentation, but maybe misallocation of resources, they will often come in and push a company to change what they're doing operationally based on their reading of the financial statements.
Oh yeah. I mean, that's important to do. Like, we have the board of directors that's serving as the role of governance. We have the managers, and the manager's interest may be different than that of the shareholders. We call that an agency relationship in finance. And so, of course, the managers are going to look out for the managers and not necessarily the shareholders.
Right.
And that's why a lot of compensation for managers is in the form of stocks to align those interests. But even with that, it's good to have a board, maybe some active investors on that board of directors that will oversee the operations of the firm, and to make sure that resources are allocated to more efficient uses, or what the board thinks are more valued uses.
Mm-hmm. All right, so let's take a step back to something you said earlier. So, you talked about valuing companies and looking for undervalued or overvalued companies. I think this is a subject we're going to dive into a lot of detail over time as we learn how to read these financial statements by going through individual statements and going sort of step by step, at least through how you look at them and what your process is. But I'd love to hear more from your perspective of different ways to value companies and how you use the financial statements to do that. And what does that mean when you're thinking about whether a company is undervalued or overvalued?
Okay. The idea of under and overvalue would be what we value the company at relative to its price. So if the price is, say, $20 a share and we value it at $30 a share, then we consider it to be undervalued. And similarly, if it's selling for 20 and we value it at 15, then we'd say it's overvalued. From here, what we're going to look at is we would try to look at the ratios, which are computed from the financial statements. We kind of look at those through time. And from those financial statements, the income statement, balance sheet, statement of cash flows, we'll get a thing called free cash flow. And we'll try to value the firm maybe based on free cash flow. And free cash flow is simply the cash flow available to all the investors, including bondholders, debt holders, preferred and common stockholders, after the firm has made the investments to run the business. This is a newer model. In the past, when I was younger, people used to look a lot at just earnings. But what we see is that earnings can be manipulated in the short run. So we've moved to this idea of a free cash flow model. And so what we would identify is cash flow, this free cash flow concept, and then forecast the growth in that free cash flow over time, and then find what we call a present value. So we discount this back to the present, and we get our value, and then we compare that to the actual price. Other models might include a market multiples or a comps model. I see a lot of people doing that just because it's easy to use, easy to understand. I do caution around that. You can miss significant items that can add or detract value if you're just looking at one ratio, say a ratio of how many times you want to value the firm, say maybe 3 or 4 times sales or earnings or EBITDA, earnings before interest, taxes, depreciation, and amortization, or something like that. And that's a clean approach because there's a lot of nuances with some of the what we call discounted cash flow models, like the free cash flow model I just mentioned.
Free cash flow is a funny one, right? Because it's such an important thing to know, and yet it's not reported by companies.
Oh yeah. So, and also the wrinkle that is what is necessary to run the business,
right?
You know, as outsiders, we just see what they bought. We see that they bought new plant, equipment, maybe another company. We can see that from the financial statements. But we don't know whether that was necessary to run the business. Maybe the firm just bought that to make the firm bigger. And maybe if the firm's bigger, management, maybe they can get a larger compensation.
Right.
So, we don't know that as outsiders, sadly, but the best we can do is just kind of see what they're doing and hoping that what they're doing is reasonable.
And so then the other terms that you used, you said you can take the free cash flow and use that to calculate a net present value. Is that's a discounted cash flow analysis? Yes. And so what are the key assumptions that you have to rely upon to do that kind of analysis?
Okay, first we'd have to assess the firm. Let's say if we're modeling based on free cash flow, so we find an estimate of free cash flow, and then from there we have to, using our valuation models, have to forecast the growth in those free cash flows. Now, maybe we can use analyst forecasts, other people telling us, or maybe we can look at it. Now, typically what we would look at is what has been the growth in the past. And I tell my students that, we go back maybe 6 or 11 years of financial statements and calculate 10 different growth rates. And then from that, maybe get an average, maybe a weighted average of those growth rates. And then that becomes our base. And then I tell people that, okay, from here, we can adjust that base to reflect other information that we might have, information about the industry, the overall economy, the people in the firm. And that could adjust our historic average growth to be a little higher or a little lower. And if we don't know any better, we can just use the historic average. So we have that growth. It could be constant or non-constant. When we have non-constant, more realistic, but more and more stuff to estimate and assume. Right. So we have these series of cash flows, and then we find what we call the present value of those cash flows. So we'll take an interest rate that we'll call a required rate of return. This could be the firm's weighted average cost of capital, weighted average cost of raising funds, debt, short-term, long-term, preferred, and common stock. So a weighted average of those. And we might use that as the rate that we use to find the present value of those cash flows. Truly an art form. The model is tight. The model is well developed. Everybody loves the model. It's just those inputs that everyone has different opinions around.
And so let's just get into a little detail there, because I think you're throwing out terms that, for some of us who have the background, we sort of know how important these terms are. But many of our users might not. So you briefly talked about the weighted average cost of capital, but let's get into detail. What is that as a concept, and then how do you calculate it?
Okay, notice the name weighted. So it's a weights based on how those assets are being financed, so we use either book values, where we get it from the financial statements, or market values to get it. And then there's a lot of issues around the weighted average cost of capital, the estimation of it. It's been problematic for over 50 years. I'm doing some research with one of my colleagues at Villanova, Mike Pagano. He came up with this clever idea of a new way of measuring the cost of capital, the cost of raising funds. We're quite excited about it.
Okay, that I want to hear about, but maybe not on this.
Yeah, another time on that. So we look at this, and so we have these weights, and think of those as proportion of funds that come from debt or preferred or common stock.
Right. And so a company wants to raise money, and they can do so in a couple of different ways. They can issue debt, which has an interest rate, a cost in terms of the interest they have to pay, right? Yeah. Or they can issue equity, which doesn't have a cost from an interest rate perspective, but does from a dilution perspective, right?
Yes, and the opportunity cost. Now, in the case of debt, we would put that on an after-tax cost basis. So the firm is issuing new debt, and let's say they have to pay an interest rate of, say, 8%. Then the true cost of the firm will be that 8% times 1 minus the tax rate, because the U.S. government, under current tax laws, makes the interest deduction, makes the interest expense a deduction. So the net cost of the firm is much less. The real problem, though, is estimating the cost of equity. As you mentioned, it's not explicit, but it's more an implied type of estimate. And that's the one that's really been problematic. The finance people have what we call asset pricing models. They have these models to try to find that cost of equity. Our accounting brothers and sisters have a thing called an implied cost of capital, where they use analyst forecasts to find that cost of equity. And then, looking at surveys of practitioners, and they just kind of wince at it. I've seen some where there was one study that the group that were surveyed, financial professionals within the firm, that they acknowledged that the cost of capital that they are using could be off by 100 to 150 basis points. Mm-hmm. So if they came up, in other words, if they had a cost that they're using of 10%, then they readily acknowledge that the true cost could be maybe 8.5 to 11.5%.
Yeah, it's quite a range.
That's a huge range, and that in itself is going to maybe influence your go no go decision.
Right. I think that's the most important part. So here we're sort of off on this digression. We're talking about the weighted average cost of capital and, some of these more esoteric concepts, but it really gets to the essence of what a company exists for, right? And that is that the company can raise money at a certain cost, right? It has to pay to raise money, whether it's equity or debt, but it invests that money and it realizes a certain return on that investment. And so generally speaking, companies should always raise money if the expected return on their investments is higher than their cost of capital.
Oh, yeah. And if so, then that should lead to an increase in the value of the stock.
Right, exactly. And that's why we care, right? That's the whole purpose of what we're here to talk about, is how to understand financial statements in this context. And maybe you as an individual might have some insight into a company's business or the reality on the ground, or a better view of the future than the Wall Street consensus, which can often be wrong. And by understanding how to sort of tease out this information from financial statements and put a simple model together, you might have a better perspective on the future prospects of the value of that company, and therefore use that to guide your investment decisions. And this is, as Gerard explained earlier, this is what fundamental analysis is.
Oh, yeah. And this, just because somebody else said, oh, this stock's good or this stock's bad, that doesn't mean that they're right. Right, they, and the driver, Dave, as you mentioned, is all around information.
Yeah.
Once you understand the models and the terms and stuff, then it's pretty straightforward. But the party with the better information set does better than those that don't.
Information is power, data is power, knowledge is power, right? That's exactly what we're here to help with, right?
Yeah. The informed take advantage of the uninformed.
Yes, that's right. And that has been true in markets since the dawn of history, as far as I know. So that's great. This has been great. Anything else, while we're on sort of financial statements at a high level, anything that we didn't cover?
No, I think that'll get people started. Like what we're basing our curriculum around is, like that person just coming into it, mm-hmm. or the person that needs a little refresher. So we're going to build it very low level. We'll give definitions for the terms, like what's a balance sheet, what's a balance of the balance sheet all about. We'll do stuff like that. And then we'll look at each individual account in each of the financial statements, try to understand what they are, kind of give some definitions to those. And then we'll build from there. We get into these things, ratios, which are just one item divided by something else, and just kind of look at those and maybe get some additional information around that. And then once we have that feel and flavor, and then we're going to combine that with what we think will be happening to the overall economy, interest rates, the industry, and we put that into our modeling. That's the qualitative piece of it to help us get good inputs. And then we have these valuation models. But all that other stuff is just to get us into the inputs that we're going to put into the models. The models are cool. They work and everything else. Everybody loves the models. It's just the inputs that we're got to deal with. And that is truly the art form.
Well, that sounds great. I look forward to getting into detail with you on all of these topics. I think it's something that everyone's going to be very interested in. And so we'll pick that up next on our next session. But thanks for joining us in this episode of Dave Talks to Experts, Dr. Gerard Olson. Really appreciate you helping us to understand what a financial statement is.
My pleasure. And I look, we're quite excited to be working with the urban people, Dave. Just want to tell you that. You guys are targeting, an underrepresented group, that retail investor. Going to try to level out some of the playing field with that. And I see that the whole idea behind urban is to help. And we're in the same issue here of we're truly blessed and we have an opportunity to do some good here, and hopefully we will be doing some good. So that's our goal as well. That's why I look forward to continuing our relationship with you guys.